In today's video, I plan to cover the top 10 dividend stock most likely to double your money within 5 years. To help tell the story, in this chart I've modeled out 10 of these stock as a combined investment at 10% in each stock and compared that to the S&P 500 over the past 5 years, where I've invested $10,000 into each of these two options. These combined top 10 dividend stock outperformed the S&P 500 by 102% in returns over the past 5 years. That's a huge difference from having $22,000 from the S&P 500 versus $46,000 from these dividend stock, where it more than quadrupled that $10,000 initial investment. And when we look at drawdowns or years where the market had a negative return, these top 10 dividend stock in the dark blue consistently had smaller drawdowns or negative returns compared to the S&P 500. And honestly, that is a very good thing. Overall, this is a winning combination that I think everyone wants within their portfolio. This group of stock performed higher than the S&P 500 in the best of years, and it performed better during the drawdown years, which really helps mitigate risk within your portfolio, which is something that we would expect from top-performing dividend stock. Let's begin by listing my criteria in selecting these dividend stock. I created a weighted point system across the year-to-date, 1, 3, and the 5-year returns, where I chose the companies that had the best result. In addition, I only reviewed companies having a dividend yield of at least 0.6%. So in case you're wondering why a specific company didn't make my list, it's because of these criteria. And I also want to recognize that past performance is no guarantee for future returns, but it does give me some form of baseline for a comparison. Let's jump right in with the first company of Lam Research, with the symbol LRCX, which is a major supplier of wafer fabrication equipment and services to the semiconductor industry. The company designs and manufactures products used in deposition, etch, and clean processes that are critical steps in the manufacturing of integrated circuits, processors, and GPUs. This happens to be a company that works closely with Taiwan Semiconductor, that manufactures most of the GPUs for NVIDIA. And if you happen to need a reminder, NVIDIA is up over 180% year to date. My point is that Lam Research supplies the equipment that the large semiconductor manufacturers rely on. And if you've seen any of my other videos, then you know that the AI boom will drive demand and growth in the semiconductors area for several years to come. This is why Lam Research is up over 73% in the trailing 12 months, then a 20% CAGR or compounded annual growth rate at the 3-year mark, and a 43% CAGR at the 5-year mark. And as a quick reminder, CAGR or compounded annual growth rate is saying that it averaged an annual return of 43% every year over those 5 years. And that happens to be an exceptionally high number, where the volume is a decent number, which happens to give the stock liquidity in case you need to sell it, and the dividend yield is at 0.74%. Now I realize that's not a very high dividend, but I can't disagree with that level of growth. And if you're concerned about the future growth for semiconductors and tech, in looking at this graph, it gives us an estimated roadmap for technology adoption for mobile internet, where the hardware and chip manufacturing in gold is the beginning of that life cycle, which also seems to hold true for the growth within artificial intelligence. I happen to love this stock, and I've had it for quite a while, where it gives me great growth, but I also appreciate that it also gives me a dividend to help during those market downturns. The next company is Novo Nordisk, where it is a leading global healthcare company specializing in diabetes, obesity, and therapies for rare endocrine disorders. But I believe that people are most familiar with their GLP-1 drug, Wegovy, along with Ozempic, which has taken the world by storm to help in the battle of obesity and also in diabetes. In fact, it is so popular that they've acquired 3 new manufacturing sites to ramp up production of these products. To date, demand has exceeded production, and once they're able to get more product out the door, the potential for this company to grow is tremendous. Their performance is another great example when you look at the trailing 12-month, 3-year, and the 5-year total returns. The one downside on this chart is the drop in free cash flow, but that was due to their capital expenditures from their expansion. It's worth noting, but it does have a purpose. And now when we shift over and look at their dividend yield, it's showing at 0.68%. Yes, the space will gain in competition, but I'm also certain that Novo is working on having GLP-1 drugs that shift away from just being injected and hopefully will soon be in a pill form. Overall, I don't expect their growth to maintain that super high number, but I do expect it to be high for several years because healthcare is only becoming more expensive and the technology is moving very fast in this sector. Another option that pays 7 to 9% a month on invested capital comes from having your own business. That's where today's sponsor, Limits Express, comes into play. They work as business managers to create and manage an Amazon store just for you, where they buy and sell national branded products using your capital and business. They do all the heavy lifting and the day-to-day work. They don't get paid unless your Amazon business makes a profit. In full transparency, I have invested with Limits Express to simply vet them out and also to verify their process. My first 2 full months of sales came in at just over $12,000 with nearly a $1,200 profit. So that's a margin of 9%. I admit that the process starts a little bit slow because you need to get approvals to sell the brands and also the categories on Amazon itself. So if you're interested in learning more, I'll have a link down in the description so that you can speak directly with Kyle, which happens to be one of the co-founders. You can also check out their website down in the links below. And please keep in mind that all investments carry some level of risk, and this is not a personal recommendation. Now on to the next company of General Dynamics, which is a global aerospace and defense company operating through 4 different segments, which is aerospace, combat systems, marine systems, and technologies. This company manufactures business jets through its Gulfstream subsidiary, designs and produces combat vehicles and weapon systems for military, constructs nuclear-powered submarines and surface ships, and provides mission-critical IT services to defense and federal clients. Key growth areas for General Dynamics include emerging technologies like hypersonics, directed energy systems, autonomous systems, and advanced manufacturing capabilities. Having spent nearly 13 years in the military, I am extremely thankful for our advanced military systems, and I believe that spending in this area will always be necessary as threats continue to grow. That's why the performance for total returns across the board looks great. It is lower than the prior 2 at the 3 and the 5-year mark, but those are still very good returns. And the dividend growth has continued at over 6% across each of those timeframes as well, where the dividend is currently at a solid 1.8%. Let's move on to the next company of Broadcom with the symbol 𝐓𝐸, which is a global company that designs, develops, and supplies a wide range of products across 2 main segments: semiconductor solutions and infrastructure software. And within semiconductors, they work on solutions for wireless networking chips, Ethernet switches, and Wi-Fi chips for a broad range of customers. And with their software solutions, they focus on automation and cybersecurity, where a few years back they acquired Semantic Security to broaden their product base to include cybersecurity, which in my opinion will be a very hot sector of software solutions for the foreseeable future. I quickly want to cover on their performance, where I'll share that Broadcom's dividend is at a healthy 1.14%. And when we look at their growth over the last year, it's over 100%. And their 3 and 5-year CAGRs, well, it's really out of this world. Seeing as how $10,000 invested 5 years ago with Broadcom would be worth over $79,000 today. If you had that in your portfolio, you'd probably be looking at your results today and literally say to yourself, holy Schitt's Creek is a great show. You know what else is great? Pressing the like button so my content here on YouTube can continue to grow. It would also be great if you subscribed or kept up with my portfolio and updates within my free newsletter. The next company is Walmart, which there's really no need for me to cover what they do. Their model for having the lowest prices is world-renowned. And when inflation is as high as it is today, then more people shop at Walmart, and it really shows in their growth, where the performance over the last year, 3-year and 5-year, consistently beat the S&P 500. So it is a solid choice for a stock, and it has a very nice little dividend of 1.18%. Walmart is a solid stock to own for both the good and the bad times. Given that they have the best prices in town, they will always have a lot of shoppers that rely on them, especially during a recession. The next company is Microsoft, which we all know them to be a software giant with Windows, along with their hardware and gaming divisions for the Xbox consoles. But a major growth engine has also been their web hosting arm with Azure, which competes with the likes of Amazon and Google. But recently, Microsoft made a major push in developing Copilot, which is an AI infrastructure change to their entire Windows products, where it's estimated that it will add an extra $10 billion a year to the company for the next 2 years. I believe that Microsoft will benefit a great deal from early adoption of AI, and it will add a lot of momentum to their already fast-growing stock. And in looking at the performance over the typical 3 time periods, as the rest, it is doing great with very high returns. Having a 5-year total CAGR of 28% is just such a great number for such a large company. And we can't forget about their dividend, which is a bit low at 0.66%, but with the great overall growth, this is a top stock to have within your portfolio. Now let's move on to the next company of Taiwan Semiconductor with the symbol TSM, where they are the largest semiconductor manufacturer, where their market share of production is over 59%. In addition, they also have the highest margin rate among its competitors at over 52%. And I know that some people will have concerns about China invading Taiwan, and honestly, that is a fair concern to have. But please know that they have massive expansion plans for plants across the world. This is a great chart showcasing all the plants coming live in the United States in gold, Japan in the blue, Taiwan in green, and Germany in the purple. And the purple one, or Germany, hasn't even broken ground yet, at least not that I'm aware of. The point is that there will be a lot of plants being built in hopes to minimize their risk. But honestly, there is no guarantee when it comes to politics and warring nations. But on a brighter note, their performance is stellar across the past year, 3-year, and the 5-year, just like so many of the other stock from today. And their dividend yield is fairly decent for a tech company at 0.85%, where most tech companies exclude dividends because they happen to reinvest them back into the growth of the business. Let's now shift over to the next company of Phillips 66 with the symbol PSX, which is a diversified energy manufacturing and logistics company, where they happen to operate through 4 main segments of midstream, chemicals, refining, and marketing and specialties. I think we all know that they operate refineries converting oil to gas, but they also have a chemical division that produces an array of petrochemical products and resins. They also work a great deal with processing and transporting of natural gas. And an area not many realize is they are also pushing hard into renewable energy resources to support the transition into the distant future to move away from fossil fuels. I'll begin by stating that they have one of the highest dividends of the group at 3.16%. This is more of what I would expect from a large oil company with solid performance. And speaking of performance, Phillips 66 had a pretty rough 12-month stretch, and I'm taking a guess that that may continue for another 3 months, but then again, maybe not. And now when we look at a bit of the long term over the 3 and the 5-year performance, you can see that it was obviously very strong. Now on to the 9th company on my list, and that is Qualcomm, which is a leader in semiconductor design and telecommunications, where you may recognize their Snapdragon processors that are in Android phones, tablets, and mobile devices. They also produce the 5G modem chips used in Apple phones and a lot of other electronics. In addition, they have a large market in low-power chips used in the Internet of Things devices and also in automotive infotainment systems. Now let's take a look at their performance over the last year, which is over 94%, and the 3 and 5-year total returns are both over 20%, which is extremely high. And this all comes with a very healthy dividend return of 1.43%. You're getting a great return, and it also has a very healthy dividend, which is really the best of both worlds. Before I cover the last company, I realize that it's pretty hard to visually compare all 10 companies on the screen for you to review. For that reason, I have a free spreadsheet down in the description with all of these companies and several more that I compiled for my research. So please, feel free to check it out and research it further on your own. And the final company on my top 10 dividend stock is AbbVie, with the symbol ABBV, which is a global biopharmaceutical company that focuses on developing and commercializing innovative therapies, like their flagship product, 𝐓𝐸, which is used to treat autoimmune diseases like rheumatoid arthritis and Crohn's disease. They also have a strong presence in the areas of immunology, oncology, and neuroscience. Given the potential for major breakthroughs in medicine, I believe that many pharmaceutical companies will have tremendous growth for many years to come, which AbbVie has seen in their performance, where if you look at the 3 different time frames, it's pretty decent overall. Granted, it isn't the highest returns of the group, but it happens to be in a different sector where I believe that it's going to have very long-term potential. That, and it also happens to have the highest dividend return of the group at 3.54%, which once again, it truly helps during those downturn years. Don't forget to check out my spreadsheet for the entire list of companies that I had considered. And if you think that I had missed one that meets all of my original criteria, then please share it in the comments. Thanks so much for watching.